At exactly 4 o'clock Eastern Time, preliminary reports hit the institutional trading desks. The rumor indicated the United States administration was preparing to implement a baseline 10% flat tariff on all global imports across 185 individual sovereign nations. The initial market reaction was remarkably muted. Standard futures indexes actually ticked upward by 2%. Algorithmic traders factored in a predictable baseline level of protectionism and assumed business would largely continue as usual. That temporary stability collapsed 26 minutes later. At precisely 4:26 p.m., President Donald Trump took the podium and began detailing the exact breakdowns of specific localized tariff brackets, country by country. The financial reaction was instantaneous. Within a mere 16 minutes, the S&P 500 futures capitulated, plummeting 4% straight down from their intraday highs. Over $2 trillion in corporate equity market capitalization was wiped off the board. This chart of the NASDAQ 100 futures shows the reversal. Earlier, the index surged upward by 400 points. As the nations were detailed, it reversed course, crashing 500 points into deep negative territory, tracing a 900-point swing in minutes. High-volume technology giants absorbed the absolute brunt of the algorithmic sell-off. Companies like Alphabet and Google, which rely on heavily integrated global supply chains and face intense regulatory pressure, flashed heavy individual losses of up to 5.6%. The trading desks panicked because the incoming data completely defied their standard models. To understand why investors were so spooked, we have to look past the top-line numbers and analyze the actual structural mechanics of the executive declaration. The media narrative immediately focused on a universal flat 10% administrative import tax. The data shows this is a complete illusion. Instead of a flat tax, the administration introduced a highly targeted framework known as reciprocal tariffs. Comprehending the exact mathematical mechanics behind this reciprocal engine is the only way to navigate the macroeconomic volatility heading toward the financial system. This diagram illustrates the core mathematical logic of a reciprocal tariff. Under this protocol, the United States analyzes the exact import tax a foreign country charges on American-made goods and then matches it with a calibrated U.S. tariff on their imports entering the American market. The friction emerges when applying this to nations with high protectionist barriers. Institutional trade data shows China reportedly charges the United States an effective tariff rate of 67%, an aggregate number built on structural currency manipulation and state-subsidized industrial barriers. Under the new reciprocal protocol, the United States is mathematically responding by locking a 34% targeted tariff rate specifically onto incoming Chinese goods. Similarly, the European Union maintains an effective tariff structure hovering near 40% on select American manufacturing and agricultural exports. The United States is balancing that specific trade friction by hitting European imports with a targeted 20% tariff. This policy operates as a surgical, asset-by-asset reset of the global trade taxation landscape. Severing vital global supply chains carries the inherent danger of starving domestic manufacturing capabilities. To prevent a domestic economic collapse, the administration built in critical exemptions. Goods that comply strictly with the United States-Mexico-Canada agreement continue to maintain a 0% baseline tariff rate, preserving poor North American trade routes. The administration also exempted 4 highly strategic commodities from the reciprocal tariff structure. First, advanced semiconductors, the high-tech components required for everything from smartphones to artificial intelligence development. Second, essential pharmaceuticals and healthcare supplies are excluded to maintain basic domestic healthcare stability, a pivot from earlier political statements proposing heavy medical import taxes. Finally, the directive protects vital raw resources that cannot be internally extracted, such as refined copper, energy products, and essential lumber articles. By explicitly carving out these massive defensive concessions, the administration demonstrates a clear awareness that cutting off the world entirely would jeopardize the United States economy. The administrative timeline dictates a 2-step rollout. On April 5th, the baseline 10% framework goes live. 4 days later, on April 9th, the highly individualized, nation-specific reciprocal multipliers kick into full effect. Global manufacturers are panicking over these exact execution dates. Right now, they are rushing to dump massive amounts of inventory into American ports before the new trade taxes officially activate. Analysts confirm this import rush is actively causing the largest single-week trade deficit in the history of the United States. The mere anticipation of these geopolitical deadlines is causing a measurable shift in how inventory moves across the ocean as companies attempt to front-run the tax. This historical chart tracks the average United States tariff rate from 1900 to 2026. When these reciprocal policies go live, the rate is projected to spike significantly, reaching a level higher than the trade barriers recorded in 1946. Notice the warning metric. Leading macroeconomic analysts project this level of trade disruption will impose a 150 basis point drag on overall U.S. gross domestic product growth. That translates to a direct 1.5% reduction in macroeconomic velocity. Institutional capital hates systemic uncertainty. A sudden disruption to international trade models creates intense ripple effects across every global corporate earnings model. Because these tariffs are highly localized and tied to dynamic foreign responses, the noise in the market makes it nearly impossible to predict the next specific winner or loser. Attempting to time individual policy shocks becomes an exercise in pure speculation. To neutralize this high entropy environment, the most effective tool is strict, automated dollar cost averaging. By consistently investing identical capital allocations at fixed intervals, an investor captures the long-term upward trajectory of the economy while bypassing the volatility of individual policy announcements. Maintaining absolute portfolio discipline and ignoring sensationalized noise is the only proven method to protect long-term purchasing power as the rules of international commerce are rewritten.